For more than half a century, one currency ruled the world. The American dollar became the backbone of global trade, finance, and power. Nations trusted it. Markets depended on it. Entire economies were built around it. But today, that foundation is beginning to crack. Inflation is rising. Debt is exploding. Trust is eroding. And countries across the world are quietly preparing for a future beyond the dollar. This is not a story about a sudden collapse. It is a story about slow erosion, hidden shifts, and a global system approaching a historic turning point. The rise of the American dollar was not inevitable, nor was it the result of a single decision or moment in history. It emerged from the ashes of global destruction, shaped by war, power, and carefully constructed trust. Before the 20th century, the global financial system was fragmented, built around gold reserves, colonial currencies, and regional trade networks. No single nation controlled the flow of global finance. That balance was shattered by the two world wars, which devastated Europe and reshaped the economic hierarchy of the planet. While much of the industrial world lay in ruins, the United States emerged with its factories intact, its infrastructure untouched, and its gold reserves unmatched. At the end of the Second World War, the United States held the majority of the world's monetary gold and controlled a dominant share of global industrial output. This unprecedented position allowed American policymakers to redesign the international financial system. The Bretton Woods Agreement established a new order in which global currencies were tied to the dollar, and the dollar itself was tied to gold. In theory, the system promised stability. In practice, it placed the United States at the center of global trade and finance. Nations needed dollars to rebuild their economies, purchase goods, and stabilize their currencies. Trust in the dollar became trust in the American state. The dollar's dominance was reinforced by America's economic and military power. The Marshall Plan flooded Europe with dollar-denominated aid, accelerating recovery while deepening reliance on the American currency. Global trade increasingly settled in dollars, especially for commodities such as oil, food, and industrial materials. Over time, the dollar became more than a medium of exchange. It became a global reserve, a store of value held by central banks around the world. Nations accumulated dollar reserves as a form of insurance, believing that the currency represented stability, liquidity, and political security. As global trade expanded, so did the dollar's influence. American financial markets became the deepest and most liquid in the world. Wall Street transformed into the nerve center of global capital flows, attracting investment from every continent. U.S. Treasury bonds were treated as the safest asset available, allowing the American government to borrow at low cost. This unique position gave the United States what economists later described as an exorbitant privilege, the ability to finance deficits, consume more than it produced, and run persistent trade imbalances without triggering immediate crisis. The system appeared self-sustaining. Dollars flowed outward through trade deficits, military spending, and overseas investment, then flowed back as foreign governments and institutions purchased American assets. This recycling of dollars reinforced U.S. financial dominance. While other countries were constrained by balance of payment pressures, the United States could issue debt in its own currency and rely on global demand to absorb it. For decades, this arrangement fueled growth, innovation, and geopolitical influence. However, the foundation of this dominance rested not only on economics, but on confidence. The dollar functioned as the world's anchor because governments, corporations, and investors believed in its long-term stability. That belief was tested repeatedly. Inflationary pressures, political crises, and wars strained the system, but each time the dollar survived, emerging stronger. When the gold standard was abandoned in the early 70s, many predicted the collapse of dollar credibility. Instead, the world adapted. The dollar shifted from being backed by gold to being backed by trust, military power, financial depth, and the absence of viable alternatives. Global news throughout the late 20th century reflected this reality. Financial crises in Asia, Latin America, and Eastern Europe reinforced the dollar's role as a safe haven. During periods of turmoil, capital flowed toward American assets, strengthening the currency even as instability spread elsewhere. The paradox became clear. Global crises often increased dollar demand, allowing the United States to remain insulated from shocks that devastated other economies. Yet this dominance came with hidden costs. As the dollar became the backbone of global finance, the American economy grew increasingly dependent on consumption and debt. Manufacturing declined as imports became cheaper. Trade deficits widened year after year. Entire regions lost industrial capacity, while financial services expanded rapidly. The strength of the dollar benefited consumers through lower prices, but it hollowed out domestic production and increased reliance on foreign supply chains. By the early 21st century, cracks began to appear beneath the surface. The sheer scale of global dollar usage created systemic risks. When the United States experienced financial stress, the effects rippled across the world. Dollar shortages emerged during crises, forcing central banks to intervene. The Federal Reserve quietly became the lender of last resort, not only for the American economy, but for the global financial system. Swap lines and emergency liquidity programs stabilized markets, but they also revealed how dependent the world had become on a single currency controlled by one nation. International observers began questioning whether such a system was sustainable. As global power shifted and new economic centers emerged, the concentration of monetary influence in American hands became a source of tension. Countries that relied on the dollar found themselves vulnerable to U.S. monetary policy decisions over which they had no control. Interest rate changes in Washington affected economies thousands of miles away, shaping growth, inflation, and financial stability across the globe. The rise of the American dollar was therefore not just a story of success, but of imbalance. It created an interconnected world where prosperity and vulnerability traveled along the same channels. What once appeared as an unshakable pillar of global finance was in reality a system built on trust, power, and historical circumstance. As the world economy evolved, that foundation faced pressures it had never encountered before. And with those pressures came a question that now defines the global financial landscape. Not how the dollar rose, but whether it can remain where it stands. The dominance of the American dollar brought undeniable advantages to the United States, but it also created hidden costs that accumulated quietly over decades. What appeared to be a position of strength gradually evolved into a structural imbalance, one that reshaped the American economy in ways few fully understood at the time. The dollar's role as the world's primary reserve currency allowed the United States to live beyond its productive capacity, importing more than it exported and financing persistent deficits with little immediate consequence. This privilege insulated the country from short-term pressure, but it also encouraged long-term vulnerabilities that became increasingly difficult to ignore. One of the most significant costs of dollar dominance was the erosion of domestic manufacturing. As global demand for dollars remained strong, the currency stayed relatively expensive compared to others. This made American exports less competitive while making imports cheaper for U.S. consumers. Over time, corporations found it more profitable to move production overseas, where labor and operational costs were lower. Entire industries that once supported middle-class employment declined or disappeared. While consumers benefited from lower-priced goods, the loss of industrial capacity weakened economic resilience and hollowed out large regions of the country. Economists later observed that the trade-offs of cheap imports were far greater than initially assumed. Trade deficits became a permanent feature of the American economy. Year after year, the United States imported more goods and services than it exported, paying the difference with dollars that the rest of the world was willing to hold. Foreign governments and institutions recycled these dollars by purchasing U.S. Treasury bonds and other American assets. This arrangement kept borrowing costs low and supported financial markets, but it also entrenched dependence on foreign capital. The American economy grew increasingly financialized, prioritizing asset appreciation over productive investment. Critics argue that the system rewarded speculation and consumption while discouraging long-term industrial development. The ability to issue debt in its own currency transformed the behavior of the American government. Fiscal discipline became less urgent when deficits could be financed easily. Public debt expanded dramatically as spending increased on defense, social programs, and crisis interventions. Each expansion was justified by the assumption that global demand for dollars would remain constant. For decades, that assumption held true. Even during periods of political dysfunction or economic stress, global investors continued buying U.S. debt, reinforcing the perception that the system was stable. But beneath the surface, the scale of borrowing grew to levels without historical precedent. Global news repeatedly highlighted this paradox. During international crises, capital flowed into the United States, strengthening the dollar and lowering borrowing costs, precisely when economic fundamentals appeared weakest. Financial commentators described the dollar as the ultimate safe haven, a status reinforced by the absence of credible alternatives. Yet this dynamic created global distortions. Countries holding large dollar reserves were exposed to American monetary policy decisions. When interest rates changed in the United States, the effects rippled outward, influencing inflation, capital flows, and debt sustainability worldwide. This imbalance generated resentment among nations that bore the consequences without having a voice in the decision-making process. The hidden cost extended beyond economics into geopolitics. Dollar dominance allowed the United States to weaponize its financial system through sanctions and access restrictions. Control over global payment networks and reserve assets gave Washington unparalleled leverage. While effective in the short term, this strategy accelerated efforts by other nations to reduce reliance on the dollar. Countries targeted by sanctions began seeking alternatives for trade settlement, reserve diversification, and financial infrastructure. Even allies quietly explored options to hedge against overdependence. These developments signaled a shift in global attitudes, driven not by ideology alone, but by risk management. Inflationary pressures exposed another vulnerability. When the Federal Reserve expanded the money supply to stabilize markets or support growth, the effects were not confined to American borders. Excess liquidity flowed into global markets, influencing asset prices, commodity costs, and capital movements. During periods of rapid monetary expansion, inflationary pressures emerged both domestically and internationally. While the dollar system absorbed these shocks for years, recent inflation episodes renewed debate about sustainability. Analysts questioned whether the global economy could continue absorbing American monetary decisions without long-term consequences. Developing nations faced particular challenges. Many borrowed in dollars because it offered lower interest rates and greater access to capital. But dollar-denominated debt carried significant risk. When the dollar strengthened, repayment costs increased dramatically. Several countries experienced debt crises triggered not by domestic mismanagement alone, but by shifts in global dollar liquidity. International institutions documented repeated cycles where dollar tightening led to capital flight, currency depreciation, and financial instability in emerging markets. These crises reinforced the perception that dollar dominance concentrated risk unevenly across the global system. The American consumer economy also reflected the hidden cost of privilege. Easy access to imports and credit fueled consumption, masking wage stagnation and declining productive capacity. Household debt increased as borrowing replaced income growth. Asset bubbles formed in housing and financial markets, supported by low interest rates and abundant liquidity. Each cycle ended with intervention, reinforcing the belief that systemic collapse would always be prevented. But these interventions increased long-term debt and deepened structural dependency on monetary expansion. By the early 21st century, economists increasingly described the dollar system as a double-edged sword. It provided unmatched flexibility and global influence, but it also locked the United States into an unsustainable economic pattern. Growth became dependent on debt. Stability relied on confidence rather than fundamentals. Manufacturing declined while financial complexity increased. The benefits were immediate and visible, while the costs accumulated slowly, hidden beneath decades of apparent success. Global discussions reflected growing unease. International forums debated the risks of a unipolar monetary system. Central banks gradually diversified reserves, adding other currencies and assets. Trade agreements explored non-dollar settlement mechanisms. None of these moves signaled an imminent collapse, but together they marked a shift in perception. The world was no longer willing to assume that dollar dominance was permanent. The hidden cost of the dollar's rise was therefore not collapse, but fragility. A system that depended on continuous trust, uninterrupted capital flows, and political stability carried inherent risk. As economic power diffused globally and geopolitical tensions increased, that fragility became harder to ignore. The privilege that once insulated the United States from constraint now exposed it to a different danger: complacency. And as history repeatedly shows, systems that appear strongest often fail not from external attack, but from the weight of their own imbalance. The modern power of the American dollar rests not only on history or trust, but on an extraordinary ability to create money at scale. Over time, this power reshaped the global financial system and altered how governments, corporations, and investors understood risk. When the United States abandoned the gold standard in the early 1970s, the dollar entered a new era. It was no longer constrained by physical reserves. Instead, it became a fiat currency backed by confidence, military strength, institutional credibility, and the depth of American financial markets. This shift granted policymakers unprecedented flexibility, but it also opened the door to a monetary experiment without historical parallel. As financial markets expanded and crises became more frequent, money creation turned from an emergency tool into a standard policy response. The Federal Reserve gained the ability to inject liquidity into the system whenever instability appeared. Interest rates were lowered, asset purchases expanded, and balance sheets grew to levels once considered unthinkable. Each intervention stabilized markets in the short term, reinforcing the belief that monetary authorities could manage any disruption. Over time, this belief transformed into an expectation. Investors began to assume that downturns would always be met with support, creating a cycle where risk-taking increased and caution diminished. The growth of public debt accelerated alongside this transformation. With borrowing costs kept low by strong demand for dollar assets, the United States expanded fiscal spending across multiple fronts. Deficits were no longer treated as temporary measures, but as routine features of economic management. Large-scale stimulus programs followed financial shocks, geopolitical crises, and global emergencies. Each round of spending was justified as necessary to prevent deeper damage. Because global markets continued absorbing American debt, warnings about sustainability were repeatedly postponed. International observers closely watched this evolution. Central banks, sovereign wealth funds, and institutional investors accumulated vast holdings of U.S. government bonds, viewing them as the safest available store of value. This demand reinforced the perception that American debt carried minimal risk. Yet economists noted a growing contradiction. The stability of the system relied on continuous confidence rather than balanced fundamentals. Debt levels rose far faster than economic output, while the financial sector expanded its influence over the real economy. The illusion of stability persisted because the costs of money creation were diffuse and delayed. Quantitative easing became the defining symbol of this era. Under this policy, central banks purchased large quantities of government and corporate securities, injecting liquidity directly into financial markets. Asset prices surged as a result. Stock indices reached repeated record highs, real estate values climbed, and speculative investment flourished. For many observers, these trends appeared to signal economic strength. In reality, they reflected a system increasingly dependent on monetary expansion to sustain growth. Critics argued that easy money distorted price signals, encouraged leverage, and widened inequality by disproportionately benefiting asset holders. The global impact of these policies was profound. Because the dollar served as the backbone of international finance, American monetary decisions shaped conditions worldwide. When liquidity expanded, capital flowed into emerging markets, inflating asset prices and encouraging borrowing. When policy tightened, that capital retreated just as quickly, triggering volatility, currency depreciation, and financial stress. Several countries experienced repeated cycles of boom and bust, driven not by domestic policy failures alone, but by shifts in global dollar liquidity. This dynamic reinforced concerns that the dollar system concentrated power and risk in ways that destabilized the broader global economy. Financial news throughout the early 21st century increasingly reflected these tensions. Commentators debated whether markets were responding to real economic fundamentals or to expectations of continued intervention. The phrase central bank put entered mainstream discourse, describing the assumption that monetary authorities would step in whenever markets faltered. This belief altered behavior across the financial system. Corporations increased borrowing to fund stock buybacks rather than productive investment. Governments delayed difficult fiscal reforms. Investors chased yield in riskier assets, confident that support would arrive if conditions deteriorated. Inflation remained subdued for many years, reinforcing confidence in the system. Policymakers pointed to stable consumer prices as evidence that money creation carried limited risk. But inflationary pressures were not absent. They were redirected. Asset inflation surged while wages lagged behind productivity. Housing affordability deteriorated. Financial markets became increasingly detached from underlying economic conditions, and inequality widened. These developments hinted at imbalances building beneath the surface, even as headline indicators remained favorable. When inflation eventually returned more visibly, the response revealed the fragility of the system. Efforts to tighten policy exposed how dependent markets had become on cheap money. Interest rate increases triggered volatility across equities, bonds, and currencies. Debt servicing costs rose for governments, corporations, and households alike. Analysts warned that reversing years of monetary expansion without causing disruption would be extraordinarily difficult. The same tools that stabilized markets during crises now constrained policy options, creating a delicate balancing act between inflation control and financial stability. The role of the Federal Reserve evolved quietly but decisively. It was no longer merely a national institution managing domestic conditions. It became a central pillar of the global financial architecture. During periods of stress, dollar liquidity shortages emerged far beyond American borders, forcing coordinated action with foreign central banks. Swap lines and emergency facilities stabilized international markets, but they also highlighted how deeply the world relied on American monetary authority. The dollar system had become globalized, yet governance remained national. This concentration of monetary power carried long-term implications. Countries dependent on dollar financing face exposure to policy shifts they could not influence. Efforts to insulate domestic economies from these shocks often proved insufficient. As a result, discussions about diversification and alternative systems gained momentum. While no immediate replacement for the dollar emerged, the desire to reduce vulnerability became increasingly visible in trade agreements, reserve management strategies, and financial infrastructure planning. The illusion of stability created by money creation and debt expansion masked a deeper transformation. The global economy adapted to an environment where liquidity was abundant, risk was underpriced, and intervention was expected. Growth appeared resilient, but it was increasingly artificial, supported by financial mechanisms rather than productive expansion. The question was no longer whether the system could withstand shocks, but how it would respond when confidence itself was tested. The power to print money granted the United States extraordinary influence, but it also bound the dollar's fate to the credibility of institutions, the discipline of policy, and the tolerance of the global system. As debt accumulated and monetary tools were pushed to their limits, the margin for error narrowed. What once seemed like an unassailable advantage began to resemble a structural vulnerability, one that could redefine the future of the dollar and the financial order built around it. As monetary expansion became a permanent feature of the American economic model, the consequences began to compound in ways that were not immediately visible. What initially appeared as a tool for crisis management slowly transformed into a mechanism that reshaped incentives across the entire financial system. Governments, corporations, and investors adapted their behavior to a world where liquidity was abundant and borrowing was cheap. This adaptation created a fragile equilibrium, one that depended less on productivity and more on the continuous flow of newly created money. Public debt continued to rise alongside this transformation. Each economic slowdown, geopolitical shock, or financial disruption justified additional borrowing. Emergency spending programs expanded in size and frequency, gradually redefining what was considered normal fiscal policy. Because the United States issued debt in its own currency, immediate constraints were absent. Global demand for dollar-denominated assets absorbed the supply, reinforcing confidence in the system. Yet economists warned that the true cost of this expansion was being deferred rather than eliminated. Debt accumulated faster than the economy's capacity to service it without intervention. Corporate behavior shifted dramatically under these conditions. With access to cheap credit, many companies prioritized financial engineering over long-term investments. Borrowing was used not to expand productive capacity, but to fund mergers, acquisitions, and stock buybacks that boosted share prices. This strategy benefited executives and shareholders, while leaving underlying business fundamentals increasingly exposed. Analysts observed that corporate debt levels reached historic highs, creating vulnerability to even modest changes in interest rates. When borrowing costs began to rise, balance sheets that once appeared strong revealed deep structural weaknesses. Households were drawn into the same dynamic. Low interest rates encouraged borrowing for housing, consumption, and education. Rising asset prices created the illusion of wealth, allowing families to borrow against inflated values. This further fueled spending, reinforcing economic growth in the short term. But the system became highly sensitive to policy shifts. When rates increased or liquidity tightened, debt burdens grew heavier almost overnight. Mortgage payments rose, credit became more expensive, and disposable income shrank. What had been manageable under expansionary conditions quickly became a source of stress. Financial markets reflected these tensions with increasing volatility. Years of monetary support had compressed risk premiums and distorted valuations. Investors searching for yield moved into increasingly speculative assets, confident that central banks would intervene if conditions worsened. This behavior created bubbles across multiple sectors, from technology stocks to real estate and alternative investments. When corrections occurred, they were met with rapid policy responses that prevented collapse but reinforced dependency. Each intervention strengthened the perception that markets were insulated from failure, deepening moral hazard. The global consequences intensified. Because the dollar remained central to international trade and finance, American monetary policy shaped conditions far beyond U.S. borders. When liquidity was plentiful, capital flowed into emerging markets, strengthening local currencies and fueling credit expansion. When policy tightened, the flow reversed. Currencies weakened, debt servicing costs rose, and financial stability deteriorated. Several countries faced crises triggered not by domestic excess alone, but by shifts in global dollar availability. This pattern repeated across decades, reinforcing criticism that the dollar system externalized risk onto the rest of the world. Central banks attempted to adapt. Reserve diversification increased gradually, with more attention given to alternative currencies, gold, and regional arrangements. Trade agreements explored settlement mechanisms that reduced reliance on the dollar. New financial infrastructure aimed to bypass traditional payment systems. These efforts did not signal an immediate abandonment of the dollar, but they reflected a growing awareness of systemic exposure. Trust in the dollar remained high, but it was no longer unquestioned. Inflation ultimately forced a reckoning. As price pressures intensified, monetary authorities faced conflicting objectives. Tightening policy was necessary to restore price stability, yet doing so threatened to destabilize debt-laden markets. The scale of accumulated obligations limited the room for maneuver. Each rate increase risked triggering defaults, market corrections, or economic contraction. Policymakers found themselves navigating an increasingly narrow path between inflation control and financial collapse. The illusion that money creation carried no long-term cost began to fade. While inflation had remained subdued for years, its eventual return revealed the delayed effects of prolonged expansion. Asset prices adjusted, purchasing power declined, and public confidence wavered. Economic commentary shifted from celebration of resilience to concern about sustainability. Analysts debated whether the system could normalize without severe disruption or whether instability had become embedded. The role of the Federal Reserve grew even more complex. As global dependence on dollar liquidity deepened, its actions carried international consequences that extended beyond domestic mandates. Coordination with foreign central banks became routine during periods of stress. Swap lines provided temporary relief, but they also highlighted asymmetry. The global system relied on a single national institution to maintain stability. This reliance increased scrutiny and political tension, both domestically and abroad. The concentration of monetary power also intersected with geopolitics. As sanctions and financial restrictions were used more frequently, access to dollar systems became a strategic vulnerability. Nations outside the U.S. sphere of influence accelerated efforts to build parallel financial channels. These developments were incremental but cumulative. Each alternative arrangement reduced marginal dependence, slowly reshaping the global landscape. By this stage, the rise of the dollar's monetary power had reached a critical point. What once provided unmatched flexibility now imposed constraints. The system required constant management, continuous confidence, and precise coordination. Small errors carried outsized consequences. The margin for policy mistakes narrowed as debt levels grew and tolerance for instability declined. The central question was no longer whether the United States could create money, but whether the world would continue to accept the consequences of that creation. The dollar remained dominant, yet its supremacy rested on a delicate balance of trust, necessity, and inertia. As pressures mounted, that balance became increasingly fragile. The power to print money had built an empire of liquidity, but it also bound the future of the dollar to a system that could not expand indefinitely without consequence. The first visible cracks in the dollar-centered system did not appear overnight. They emerged gradually through a combination of inflationary shocks, geopolitical conflict, and a growing loss of confidence among nations that had long depended on American financial leadership. For decades, the dominance of the dollar masked structural weaknesses, but as global conditions shifted, those weaknesses became increasingly difficult to contain. What once functioned as a stabilizing force began to operate as a source of tension, both within the United States and across the international system. Inflation was the earliest and most tangible signal. After years of subdued price growth, consumer costs began rising at levels not seen in generations. Essentials such as food, energy, and housing increased sharply, eroding purchasing power and challenging the narrative that monetary expansion carried limited risk. Policymakers initially described the surge as temporary, attributing it to supply chain disruptions and post-crisis recovery. But as inflation persisted, Confidence in that explanation weakened. Analysts noted that years of aggressive money creation had finally collided with real-world constraints, revealing the delayed cost of prolonged monetary stimulus. The response exposed another vulnerability. Efforts to contain inflation required tighter monetary policy, yet higher interest rates placed immense pressure on debt-laden systems. Government borrowing costs increased. Corporate balance sheets weakened. Households faced rising payments on mortgages, credit cards, and other obligations. Markets reacted with volatility as investors reassessed risk in an environment no longer defined by cheap money. The delicate balance between price stability and financial stability became increasingly difficult to maintain. At the same time, the dollar's role as a geopolitical weapon reshaped global perceptions. Financial sanctions, once considered extraordinary measures, became routine tools of foreign policy. Access to dollar-based payment systems, reserves, and trade settlement channels was restricted for targeted countries. While effective in exerting pressure, these actions altered the calculus for nations worldwide. Dependence on the dollar now carried explicit political risk. Governments began reassessing whether holding reserves in a currency controlled by a single foreign power was compatible with long-term sovereignty. Global news reflected this shift. Countries explored alternative payment systems, bilateral trade agreements, and regional financial arrangements designed to reduce exposure to dollar-based infrastructure. Energy transactions increasingly experimented with non-dollar settlement. Central banks publicly discussed diversification strategies, adding other currencies and assets to reserves. None of these steps displaced the dollar immediately, but collectively, they signaled a change in attitude. The dollar was no longer viewed as neutral infrastructure. It was increasingly seen as an extension of American power. Inflationary pressures amplified these concerns. When the United States adjusted monetary policy to address domestic conditions, the effects rippled outward. Higher interest rates strengthened the dollar, increasing the cost of servicing dollar-denominated debt abroad. Several developing economies experienced capital outflows, currency depreciation, and rising financial stress. International institutions warned that the global tightening cycle risked triggering a wave of debt crises, particularly in countries heavily exposed to dollar financing. Once again, the stability of the global system depended on decisions made in Washington. Trust, the invisible foundation of reserve currency status, began to erode at the margins. While the dollar remained dominant, its role was no longer unquestioned. Financial commentators noted that confidence does not collapse suddenly, it weakens gradually, through accumulated doubt. Each sanction, each liquidity shock, and each inflationary episode added to a growing sense that the system was less predictable than it once appeared. Market behavior reflected this unease. Volatility increased across currencies, bonds, and commodities. Gold regained attention as a hedge against monetary instability. Discussions about digital currencies, both private and state-backed, gained momentum as potential alternatives to traditional settlement systems. While many of these proposals remain speculative, their growing visibility underscored dissatisfaction with the existing order. The idea that the dollar had no competitors was quietly abandoned in favor of a more cautious view. It had no immediate replacement, but it did have challengers waiting for opportunity. Domestic pressures compounded the issue. Inflation eroded public confidence in institutions, fueling political polarization and skepticism toward economic leadership. Debates over debt ceilings, fiscal responsibility, and central bank independence intensified. The perception that monetary policy favored financial markets over households gained traction. As living costs rose, trust in the promise of stability weakened further. The internal cohesion that once supported the dollar's global role showed signs of strain. Internationally, allies and rivals alike adjusted their strategies. Some sought greater autonomy by strengthening regional trade networks. Others increased bilateral agreements that bypassed dollar settlement. These moves were incremental, pragmatic, and often framed as diversification rather than rejection. But diversification itself was a signal. It suggested that reliance on a single currency was no longer viewed as safe or sufficient in an increasingly fragmented world. The cracks in the system did not indicate imminent collapse. Instead, they pointed to a gradual transformation. The dollar's dominance was being tested not by a single shock, but by the accumulation of pressures that challenged its role as a universal anchor. Inflation exposed the cost of monetary expansion. Sanctions revealed the political dimension of financial infrastructure. Market volatility highlighted dependence on continuous intervention. Each factor alone might have been manageable. Together, they reshaped the narrative. What emerged was a global environment defined by uncertainty. The dollar remained central, but its supremacy now carried visible trade offs. Stability required constant management, credibility demanded restraint, and trust depended on choices that balanced national interests with global responsibility. As these tensions intensified, the question was no longer whether cracks existed, but how far they would spread. As confidence in the dollar centered system weakened, the global response moved from quiet concern to active adjustment. What had once been theoretical discussions inside academic circles became concrete policy decisions. Governments, central banks, and corporations began planning for a world where dollar dominance could no longer be taken for granted. This shift did not happen through dramatic announcements, but through a series of deliberate, often understated actions that collectively signaled a change in the global financial mindset. Reserve diversification accelerated. Central banks gradually reduced the share of dollar-denominated assets in their portfolios, increasing allocations to other currencies, gold, and alternative instruments. While the dollar remained the largest reserve currency, its share declined steadily over time. Economists emphasize that reserve shifts move slowly by design, but even marginal changes reflect long-term expectations. The decision to diversify was not driven by ideology, but by risk management. Holding reserves in a currency subject to geopolitical leverage and domestic political volatility carried new uncertainties. Trade patterns also began to evolve. Bilateral agreements increasingly bypassed dollar settlement, particularly in energy, raw materials, and regional trade blocs. Countries sought to reduce exposure to exchange rate volatility and financial sanctions by settling transactions in local currencies or through alternative mechanisms. These arrangements were often limited in scope, but their symbolic significance was substantial. Each non-dollar transaction weakened the assumption that global trade required American currency at its core. The rise of alternative payment infrastructure further challenged the status quo. Financial messaging systems, clearing mechanisms, and regional settlement platforms expanded beyond traditional dollar-based networks. Governments invested in systems designed to operate independently during periods of financial disruption or political conflict. These initiatives did not immediately rival existing structures, but they provided optionality. In finance, optionality is power. The mere existence of alternatives reduced absolute dependence on any single system. Sanctions policy continued to influence this transformation. As restrictions were applied more frequently, countries outside the immediate sphere of U.S. influence viewed dollar reliance as a strategic vulnerability. Even nations aligned with American interests recognized the precedent being set. The idea that reserves could be frozen or transactions restricted reshaped how governments evaluated financial security. Trust in the dollar shifted from unconditional acceptance to conditional calculation. Market behavior reflected these changing perceptions. Currency volatility increased as traders reassessed long-term assumptions. Hedging activity expanded. Demand for hard assets rose during periods of uncertainty. Commodities priced in dollars experienced greater fluctuations as exchange rate dynamics became more complex. Financial news increasingly framed the dollar not only as a benchmark, but as a variable subject to political and economic risk. Inflation remained a persistent factor. As price pressures challenged domestic stability, public confidence eroded further. Central banks faced difficult trade-offs between controlling inflation and preserving growth. Each policy adjustment carried global consequences. Rate hikes strengthened the dollar temporarily, increasing strain on external borrowers. Policy pauses risked reigniting inflation. The credibility of monetary authorities became a focal point of debate, both domestically and internationally. The burden of adjustment fell unevenly. Developing economies with high levels of dollar-denominated debt faced rising repayment costs. Several experienced balance of payment stress, forcing difficult policy decisions. International institutions warned of cascading risks, as localized crises could spread through financial networks. These warnings highlighted the central paradox of the dollar system. While it provided global liquidity, it also transmitted instability with remarkable efficiency. At the same time, political polarization within the United States intensified uncertainty. Debates over fiscal sustainability, debt ceilings, and central bank independence signaled internal divisions that unsettled global observers. Financial markets, which once viewed American political disputes as background noise, began pricing in risk. The assumption that US governance would always resolve crises without consequence weakened. Technology introduced new dimensions to the challenge. Digital currencies, blockchain-based settlement systems, and state-backed digital money projects gained momentum. While none posed an immediate threat to dollar dominance, they represented potential future alternatives. Central banks studied digital currencies as tools for efficiency and sovereignty. The global financial system, once slow to change, entered a period of experimentation driven by both innovation and distrust. The cumulative effect of these developments was not collapse, but fragmentation. The dollar remained central, yet its dominance was increasingly shared, contested, and hedged against. Global finance began resembling a multipolar system in slow formation, where no single currency could dictate terms without resistance. This fragmentation reduced efficiency, but increased resilience for some participants, reshaping incentives across the system. Economists debated the implications. Some argued that diversification strengthened global stability by reducing concentration risk. Others warned that fragmentation increased transaction costs, reduced liquidity, and raised the likelihood of systemic shocks. What was clear, however, was that the era of unquestioned dollar supremacy had ended. The system now depended on active maintenance rather than passive acceptance. The cracks that once appeared as isolated stresses had expanded into structural shifts. Inflation, sanctions, political uncertainty, and technological change converged to redefine trust in the global monetary order. The dollar's power endured, but it no longer operated in isolation from consequence. Its future would depend not only on economic performance, but on credibility, restraint, and the willingness of the world to continue accepting a system built on asymmetric control. As these pressures accumulated, the question facing the global economy grew sharper. Could the dollar adapt to a world no longer willing to grant unconditional privilege, or would the system gradually erode under the weight of its own contradictions? The answer would not arrive through sudden collapse, but through a series of choices, reactions, and recalibrations that together would determine the next chapter of global finance. The future of the American dollar will not be decided by a single event, announcement, or crisis. Instead, it will unfold through a prolonged process shaped by economic pressure, geopolitical competition, and shifting global priorities. History shows that reserve currencies rarely collapse overnight. They decline gradually, losing influence through a combination of erosion, substitution, and adaptation. The dollar now stands at such a crossroads, where its fate depends less on absolute dominance and more on how the system around it evolves. One possible path is controlled decline. In this scenario, the dollar remains the primary global currency, but gradually shares its role with others. Its dominance diminishes as trade becomes more regionalized and reserve portfolios more diversified. The United States continues to issue debt, but global demand becomes more selective. Borrowing costs rise modestly, forcing greater fiscal discipline over time. This transition would likely be slow, measured in decades rather than years. Financial markets could adjust without dramatic shock, but the United States would lose some of the privileges that defined its economic power in the post-war era. Another scenario involves fragmentation rather than replacement. Instead of a single successor currency, the global system could evolve into a multipolar arrangement. Different regions rely on different currencies for trade, reserves, and settlement. The dollar remains dominant in some sectors, while alternatives gain traction elsewhere. This structure reduces reliance on any one system but increases complexity. Transaction costs rise. Liquidity becomes more fragmented. Financial coordination becomes harder during crises. While this model offers greater resilience for some nations, it also introduces new forms of instability that global institutions may struggle to manage. A more disruptive outcome would involve accelerated loss of confidence. In this scenario, a major shock, such as a severe financial crisis, political breakdown, or sustained inflation, undermines trust in U.S. financial governance. Capital flows shift rapidly. The dollar weakens sharply. Borrowing costs rise quickly, forcing abrupt fiscal and monetary adjustments. Markets reprice risk across asset classes. Such a transition would likely produce global turbulence, affecting trade, investment, and growth worldwide. While not inevitable, this scenario remains a concern among analysts who view current debt levels and political polarization as structural risks. Global news increasingly reflects debate over these possibilities. Economists, central bankers, and policymakers discuss the long-term sustainability of dollar dominance with greater urgency. Reports highlight the growing role of alternative currencies in bilateral trade, the expansion of regional financial systems, and the rise of digital settlement technologies. These developments are often framed as incremental, but their cumulative impact is significant. They signal a world preparing for change, even if it cannot yet define the final outcome. For the United States, the implications are profound. Dollar dominance has allowed the country to finance deficits, project power, and absorb shocks in ways unavailable to other nations. A reduced role would require adjustments across fiscal policy, trade strategy, and domestic investment. Greater emphasis on productivity, industrial capacity, and long-term growth would become essential. The margin for policy error would shrink as external financing becomes less forgiving. In this environment, economic resilience would depend more on fundamentals than on privilege. The global consequences would be equally significant. Countries that relied heavily on dollar liquidity would need to strengthen domestic financial systems and manage external risk more carefully. International coordination would become more complex as no single currency provides a universal anchor. Institutions designed around dollar centrality would face pressure to adapt. At the same time, diversification could reduce systemic concentration, limiting the scale of future crises tied to a single monetary authority. Technology may accelerate these shifts. Digital currencies, whether state-backed or private, offer new mechanisms for settlement and reserve management. While still evolving, they challenge traditional assumptions about money, sovereignty, and financial infrastructure. Central banks experiment cautiously, aware that innovation carries both opportunity and risk. The future system may blend old and new elements, combining established currencies with digital frameworks that reshape how value moves across borders. Yet it is important to recognize that the dollar's decline, if it occurs, does not necessarily imply collapse. Reserve currencies have transitioned before. The British pound lost its global role over decades, not days. Economic influence shifted gradually as political power and productive capacity changed. The process was disruptive but manageable. The dollar may follow a similar path, retaining influence while adapting to a world where dominance is no longer absolute. Ultimately, the fate of the dollar will depend on trust. Trust in institutions. Trust in governance. Trust that monetary and fiscal policy serve long-term stability rather than short-term expedience. Once trust erodes, it is difficult to restore. The global system does not require perfection, but it demands credibility. As alternatives grow more viable, tolerance for imbalance declines. The rise of the American dollar was built on historical circumstance, economic strength, and global confidence. Its future will be shaped by choices made under pressure. Whether the dollar remains central, shares power, or gradually fades, the transition will redefine global finance. The era of unquestioned supremacy is ending. What replaces it will determine not only the future of the dollar, but the structure of the world economy itself. The question is no longer whether change is coming. It is whether the system is prepared for it. The dollar is not collapsing tomorrow, but it is no longer untouchable. What once seemed permanent now depends on confidence, restraint, and fragile balance. And history shows that reserve currencies do not fall with a crash. They fade through miscalculation, overreach, and loss of trust. As the world diversifies, hedges, and prepares for alternatives, the era of unquestioned dominance is coming to an end. What replaces it will define global power, stability, and prosperity for generations. The shift has already begun. The consequences will be global. This is not the end of the story. It is the beginning of a new financial era. Stay informed, stay ahead. Shadow Rewind continues.